That's good. All in favor? Thank you, passed. Delegations. Jeff Lay from Wilkinson and Company, overview of the 2025 financial statements as well as the 2026 audit plan.
Thank you. So I'd just like to start out by thanking you for once again appointing Wilkinson and Company as the auditors for the city. There's three parts to the presentation. Audit findings report, which is the document that I'm required to go over to those charged with governance, being that this committee. The audit report itself on the financial statements, and then as you mentioned, the audit plan. Audit findings report, nothing new that I haven't gone over in the past in prior presentations. Once the financial statements are approved and we receive back a signed management representation letter, we can finalize the financial statements and provide you with the letterhead copy statements. During the audit this year, there were no issues noted during the audit. There were no adjusting entries proposed by us. There was a few entries received by Caleb and his staff during the audit, but there were none that were the result of any of the testing that we did. Initial planning last fall had materiality at $950,000. That was before we received the actual kind of year-end numbers. As a result of the year-end numbers, materiality was increased to $1 million. So there was a $50,000 increase just based on the increased expenses that you had from when we did the planning. We were using last year's numbers, and then when we did the audit, it was based on the actual numbers for 2025. To point out, during the audit, there are significant estimates that are made by management, by staff during the audit that as a committee, we just felt you should be aware of. No issues in our testing of the numbers. It's just because they're estimates, there could be future changes. Post-employment benefits, the asset retirement obligations, contaminated site obligations, and fair market value of assets and useful life. So those are four areas that the management's best estimates are being done for the amounts that are recorded. But down the road, if something changes in the underlying estimate or one of the underlying example could be if the useful life changes on the asset, you're then going to have to change the amount that's recorded. So no issues on the current year. Those are just four areas that hypothetically there could be changes in the future. That doesn't mean there was anything wrong now. It's just circumstances have changed. Contaminated sites. If the estimated liability or cost to reclaim changes, then there will be a change in the liability on the books. During the audit, we did not identify any significant deficiencies in internal control that would impact the financial statements. There were no unusual transactions or changes in accounting policies that would impact the financial statements, and there were no fraud or illegal acts that we came across that would impact the financial statements. If there were any of those types of transactions, we'd be reporting them to you, even if there was an unusual transaction or a change in accounting policy that we weren't expecting, even if we got an answer from Caleb and Victoria and Matt, we would be discussing it here to make sure that everyone here understood what had changed. There were no disclosure deficiencies. This is, from my standpoint, a nice audit to do in that you prepare the financial statements. We come in and audit the notes, audit the numbers, provide an audit report, but the actual statements themselves are prepared internally. We had the full cooperation of everyone involved doing the audit. There were no items of non-compliance with any laws that we came across. There were no modifications to the audit report. As in prior years, it's considered a clean audit report. And we confirm that we continue to be independent. I normally start out with the independence talk saying we're not aware of anything, but if anyone here is aware of anything, please bring it forward to either Matt's attention, my attention, anyone else's attention. If you don't feel comfortable bringing it forward yourself, we would much rather deal with it up front and head on as opposed to finding out down the road somebody had a concern about independence and didn't bring it forward. Again, we're not aware of anything that would prevent us from being independent. The audit itself, what you've engaged us to do is to provide the audit opinion, which in the 35-page of financial statements, it's the 2-page independent auditor's report, 3-page independent auditor's report. You've engaged us to provide an opinion on the financial statements. In our opinion, the accompanying consolidated financial statements present fairly in all material respects the financial position of the municipality as at December 31st, 2025. If there's any specific questions related to the financial statements themselves, the numbers, I can try to answer them, but my answer will just have come from Matt, Victoria, and Caleb. So if there's a specific number, the fact that there were no adjusting entries during the year means that what you're looking at here has pretty much already been presented to you previously in finance meetings. But if there are any questions, I'd be more than pleased to either try to answer them or defer to one of the accounting staff or Caleb to answer.
Did we want the questions now, or when we, on the staff report, when we approve all the financial statements?
Yeah, it's say the staff report, unless there's anything for
Okay.
Jeff right now, while Jeff's here, because I think we'll let Jeff leave.
Okay.
Okay, and then the third piece that is a little bit different this year than prior years because of the fall or later on in the year elections coming up is the audit plan has been circulated for next year's audit. It's a little early now in that we were not sure what materiality is going to be for next year, so that may change when we get actual numbers. Staffing on our end, although we always try to keep continuity on staff because we're now talking 10 months ahead, there could potentially be changes, not anything we're aware of, but we don't control if people decide to leave or someone goes on a maternity leave. Not that we're expecting anything, you just never know, but as of where we are now, the audit plan includes the staff and the setup that we would expect for next year. It's still, and we were just talking before the meeting started, the four of us, Matt, Victoria, and Caleb and I, if there are new changes in accounting standards that come out, we will be discussing them when they come out in terms of the implications to the reporting. There are two that we are aware of, but they don't impact your statements right now. They're for years that start after April 1st, 2026. So you have another kind of your December 2026 year end. The year after that, we're hoping not a significant change, but there is a new statement required. So there'll be some changes in how things are reported. We haven't worked through yet what that's going to look like, but it's a required change in some of the financial reporting. So the initial kind of, we were briefly discussing that not waiting until December 31st, 2027. Basically, you want to get it looked at ahead of time so that you know and you're aware what those changes will be. So that's more for a year from now than it is for the current year that we're in right now. The year ended December 2026. But that was it.
If there's a required change, you could do it for this year too, could you not, if it's not that impactful?
If it was looked at and it wasn't going to be a significant, I'll say, burden on internally on everybody, early adoption is permitted on that one. Although typically people don't go for early adoption because the changes can be fairly significant, and you normally want to wait for guidance to come out by the various reporting bodies on examples for disclosures, and it's easy for them to come up with, we want a new statement that's going to cover this, but then when they actually get into the like individual, what does it actually mean, how do you record things, there's always a lot of questions that come up. So early adoption on these isn't always the best thing to do. Again, it depends, we haven't looked at what it would actually mean to you for those statements.
Okay.
Because it is a possibility, it's just typically you don't run out and early adopt. You wait till see what the CPAO, what the different CPAB, different bodies come out with, because there'll be courses, professional development courses to help, there'll be sample statements provided so that everyone has an idea of how it's going to impact you.
Okay, thank you. Thanks for your presentation. Any questions?
Sure.
Councillor Quinte?
So I always like to help people understand these things, that this is just a snapshot of the city of Quinte West on December 31st, 2025. The very next day, everything changes. And this document is important to make sure that those that are responsible to do their jobs are doing their jobs correctly and making sure the money's going in the right places. And also, when the city applies for grants or loans or business contacts, because we are a financial institution and a charitable organization, these documents are needed to show other financial institutions that we are a solid organization, that we have assets, we have income, we have expenses, and I just like to make that comment each and every time when we have these meetings. Thank you.
Any other questions or comments? Thank you for your presentation.
Thank you.
Have a good night. Next, we have Eric Sutter, advisor. BFL Canada Risk and Insurance Services will address the committee with a summary of phase 3 of the insurance actuarial report.
Perfect. Hi, everybody. I hope everybody can hear me. I'm just going to share my screen very quickly to make sure that we're able to present the document. Is everybody able to see my screen?
Yes.
Perfect. Thank you. Just a heads up, I don't have two monitors right now, so I can't see the room and the presentation at the same time. So if there's any questions or comments, obviously following internal governance procedures, please just let me know because I can't necessarily see the room at this time. So to provide a high-level overview, so BFL Canada Risk and Insurance Services, for context, is the insurance broker of the city, and what that means is that we help place the insurance policies of the city. We aren't a counterparty to any of the insurance programs here, and the information and data that is outlined in this report is the city's. So none of this is going to be provided to the insurance companies unless it obviously materially helps the negotiating position of the city. To provide quick context, so this is to the point on the agenda, the third element or the third part of the analysis. So this started back in 2023, where we produced a actual report on the general liability errors and omissions policy, as well as the property lines that were presented in 2024 and 2025, respectively. Those analyses helped the city be in a better position to optimize its insurance structure and ultimately led to an increase in the deductible and a lowering of premium on both policies. The scope of the current presentation is the auto insurance program of the city. Now, there is some overlap in this case with the general liability program, and we're going to get into some indications as to why that's relevant for the discussion today. But at its core, our goal here is to produce the same type and elements of analyses that were presented in December of 2024 and 2025 for the GL, E&O, and property lines, respectively. The way that we got to the outcomes that we're presenting today is first, obviously, using the data and the exposure of the city to determine an appropriate modeling methodology that follows actuarial principles, and to then provide insight on three key points. Number one, is the current limit of insurance adequate for the city? Number two, is the current market pricing the exposure in a way that properly reflects the risk exposure? Is there a potential arbitrage opportunity there to take on more risk and essentially lower the overall total cost of risk of the organization? And number three, how does changing the deductible impact that decision around total cost of risk? To get to that outcome and that output, we looked not only at the city's historical loss performance on its auto insurance policy, but also looking at industry losses informed by the specific operations of the city. So what that means practically, for example, is that the transit policy, for example, is covered by a third party. So we didn't use, for example, industry losses that reflect transit losses that we've seen in other industry relevant events. And then finally, we took all that information to build the actuarial model, and it provides us numbers and data to do actuarial pricing by layer. And so we're able to not only map out your current structure of insurance against those potential losses, but we're also able to provide you insight on how to optimize it from a limit, pricing, and deductible perspective. Are there any questions at this point on the overall kind of structure or presentation as to what we were trying to answer with this engagement?
I have a comment.
Councillor Coetzee has a question.
Mr. Sadler, you mentioned earlier that your brokerage is not going to be specifically sharing this report with your insurance companies, but they could look this up. I mean, we're doing it here. This is a public meeting. The underwriters could Google City of Quinte West insurance reports, and they could find this report if they wanted to. Your underwriters at your insurance companies. Just pointing that out.
Yeah. So that's a fair point. I may want to let people at the city answer that question. It was a point that was brought up in the past, whether or not to have these presentations in public session or in closed session. But ultimately, the decision was made internally. I don't know if there's any other feedback from anyone internally to provide on that.
I don't know.
Mr. Chair, yeah, we had discussions about presenting this. We felt it was high level enough that there was no concerns with it being in public.
Yeah, I don't have a problem with it either. I was just pointing that out. But what you
Yeah.
mentioned earlier, that you're not going to share it with them, but they could find it if they wanted to. The underwriters at the insurance companies. Thanks.
Yeah. To Caleb's point as well, so we're going to go into a little bit of detail here as well, but what you'll see generally is that the way that insurers price coverage is a little bit specific, or sorry, a little bit generalized on this. So yeah, it is definitely an important point and a fair observation. But yeah, historically, it's the way it's been done.
Yep.
Perfect.
Go ahead.
So just to provide a high-level summary of the current auto insurance coverage. So right now, the city purchases up to $50 million of coverage. Now, the one important caveat to mention here is that those two excess layers, so where we see excess 1 and excess 2, which is the $45 million above your primary layer, is also shared with your general liability insurance. And that's really what drives the risk for the city. So here we're going to be talking about pricing and how those layers are priced. A lot of that falls primarily on the GL layer. There's very limited exposure on your auto policy with respect to that. So if you primarily, when we're discussing pricing there and adequate limits, you have to look at it holistically. And so that's why I would invite the committee, if there's any interest there, to primarily look at the report from 2024 rather than this one to determine whether or not the current limit of insurance is adequate with respect to those layers. So to provide an overall summary, we modeled multiple different approaches here, and the final model that we had your average loss at about $112,000, and your worst case scenarios being somewhere between $1 and $2 million for a 1 in 100 year or 1 in 1,000 year event. Now, incidents can get much worse than this, and we've seen it in the industry. But given your specific risk profile, they're not expected to be particularly likely, and so they end up being at much higher percentiles for the organization. The high-level summary is that the current structure is somewhat conservative. So that's true for both the deductible and the primary layer limit. So the 10K deductible sits at about a 60%, 58.1% exceedance probability, which means that you have about a 58% chance of transferring a loss to the insurance market in any given year. Now, that's what creates what we call a dollar trading relationship with insurers, where essentially you're paying them $1.50 for every dollar of claims that they cover because they have admin costs and other, certain profit margins that they target. And so actually, the more you transfer to your insurance program, it doesn't mean that you're getting value for your insurance. It actually generally means that you're getting charged premium in exchange for them paying those claims that you could have just absorbed internally to actually lower your total cost. The limit of insurance as well is quite conservative. It covers above the 99.99th percentile. Now, that does not mean there cannot be incidents that occur above that, but they would have a very low likelihood. So all that tells us is that level of conservatism naturally reflects in the pricing. And so currently the program is priced inefficiently by the market. That is to say that the relative to its risk, the city is paying more money than what would be predicted technically. Now, we're going to get into a minute why that tends to be the case, but that is an important piece of evidence to indicate that there may be value in increasing the current level of retention for the city. It's also important, back to the point I was making earlier, that a lot of this pricing discrepancy is also in the excess layers. But even when you look at just the primary layer, that first $5 million, there is still value likely in increasing retentions. So what we looked at is to increase the deductible, likely between $50,000 to $100,000, which would increase the average annual loss paid out of pocket from $27,000 to $33,000. Now, that doesn't mean that's going to happen every year. When you increase your deductible, you're taking on more risk. So some years maybe you'll pay $100,000 more, other years there'll be no difference. But ultimately, that's what we expect to be the main actuarial loss. Typically, when we presented these reports in the past, we did so in December, but with the change in council, we wanted to make sure to present them sooner rather than later. As such, when this is reviewed closer to the insurance renewal, we will consider not only what the increase in losses look like, but also what pricing credits are being offered by the insurance company to make sure that you're actually getting value for money there from increasing your deductible. And in that case, even when increasing the deductible to $100,000, you do have an increase in volatility. So at the 1 in 100-year event, you'd be paying $175,000 out of pocket. But the expectation is that given the insurance market, we would be hopefully able to get premium credits that are greater than that if we increase the deductible. And obviously, that's going to be compared once we're closer to the renewal date. So to provide an overall summary, the current limit of insurance is conservative. However, a lot of that is, number one, because of the GL exposure being most of what is captured by those excess policies. And second of all, there's always, given the price that you're paying, you get access to very cheap capital in case of an incident. So it does protect the balance sheet of the city. With respect to the deductible, increasing and or extending the deductible would likely provide value to the city, and we'll get into details as to what we mean by extending the deductible. But of course, you always need to benchmark that against the premium credits you would get, as well as the risk appetite and financial capacity to retain the risk of the city. And as well, increasing the auto deductible will help align Quinte West's risk appetite across multiple lines. As mentioned in the introduction, we already increased the deductible on the GL, E&O, and the property policies. And so this would help the city get more in line with those deductibles. Now, because auto naturally is a line where you see a little bit more frequency, and because the deductible currently is quite low, we didn't immediately recommend to jump to the $250,000 deductible, but that is something that the city could choose to do or choose to do over time. Are there any questions at this point before we dive a little bit deeper into what some of this means?
I don't see any. Perfect,
thank you. So let's start by talking about what we mean by market pricing. So typically when an insurance company looks at a city, they don't really look at your specific risk profile. What they look at is high-level exposure. So what's my fleet size? What are the values? What are the kilometers traveled? They look at your loss history and ratio. So over the last 5 years, how many bad losses have you had? How much premium do you pay? And they compare you a little bit to your industry. So other cities with similar size or similar exposure or similar loss history, what does that tell us? And so you get put into these very generalized buckets. And the downside of that is that depending on your performance and depending on your risk management approach and your unique circumstances, you may be paying a price that is not really aligned with the underlying risk, but rather the market conditions that you're in. And so what the actuarial model tries to do is to dive a little bit deeper into what your specific risk profile tells us and how that benchmarks against the wider insurance market pricing to try and find some gaps. To say, are we actually benefiting from this generalized pricing? Is our risk worse than they expect? Or is it something that's actually increasing our pricing? And so we should actually take on more risk, put some skin in the game, and in turn actually reduce our total cost of risk over time. So when we looked at the overall exposure insurance program and historical loss, there weren't many large losses in the data set. It was actually the one significant case that happened was a building fire that happened back in 2014 where multiple vehicles were damaged in the building. Now, Typically, that's not a traditional auto loss. We often see those more as fortuitous losses and are actually more aligned with the loss distribution you'd see on your property program rather than your auto program. Obviously, in this case, it went through your auto policy. But if you look at your other years in general, you can see that your highest loss year other than 2014 was 2024, where you had $222,000 of losses in today's dollars. And generally, many years you actually had no losses. And so what that tells us is that this was likely a fortuitous loss, and that on average, you would actually expect to have a much lower annual claim severity than what was seen then. So overall, we saw relatively strong performance historically outside of that one fortuitous loss, which is important to keep in mind. So using that, we built our model, and when looking at the limit adequacy again, that sort of catastrophic losses were not showing up very often in the distribution. Very often, the large majority of scenarios of annual performance fell within your first layer. So that primary layer, you didn't even touch that excess layer. Again, that excess layer exists primarily to protect you against general liability insurance because it's shared coverage. We do not recommend to reduce or remove auto from those lines. It wouldn't really have an impact on the city, but it does tell you that you have a quite strong insurance position right now, and should protect you in case of a catastrophic loss. From a technical pricing perspective, we certainly see that the city's performance is better than what the insurance market would indicate. So there is inefficient pricing there. Now, again, we can't simply go to the insurance market and say, hey, we think you're charging us too much money. That's not how the insurance market works. Again, it uses more of that generalized bucket approach, but it does indicate that there's probably value in increasing the deductible, put some skin in the game and take some of that risk, because the insurance market will generally give you a bigger premium credit than is expected. Or than is mathematically suggested, because you have such a strong historical and actuarial performance that is predicted. And when looking at that specific deductible, we really recommend there is a case absolutely to be made to increase that deductible to $250,000, which would align with your property and GL insurance program. However, you currently have quite a low deductible at $10,000, and it only applies to what we call AP claims. I'll get into what that means in a minute. But we do certainly recommend to at least consider increasing the deductible for next year once there is more clarity as to what premium credit would come out of that increase. So what do we mean when we're talking about AP claims? So typically when an incident happens, you have two types of incidents. So the city can either be at fault or the city can be not at fault. So for example, if a city driver makes a mistake, gets into an accident, that would be an at-fault claim. If a city worker gets rear-ended, for example, that could be a not at-fault claim situation. The major difference between those claims are whether you have what we call first-party damage exclusively that is covered, or if you also have third-party liability. So third-party liability is whatever damage the city does to someone else's property or bodies, and first-party damage is whatever damage happens to the city's employee or to their vehicles. Now, currently, the way the insurance policy is structured only covers what we call all perils claims. So in this case, it covers comprehensive or collision losses that are at fault, or comprehensive claims that are not at fault. What that essentially means is it covers only a specific subset of potential incidents that could trigger a claim. There are other claims. So for example, third-party liability, the city rear-ends someone else's car and causes significant bodily injury or physical damage, that would have no deductible applicable. Now, that can seem attractive because typically this means that you're going to be paying less out of pocket. However, there is a cost to that that is incurred in the insurance policy. Insurers consider that when pricing their programs. And so you are paying a higher premium to make up for that change in deductible. And so depending on the city's appetite, what we did is we modeled three different alternatives. Number one, maintain the current structure of the deductible, so it only applies to those all peril claims. Adjust it so that the deductible applies to all physical damage and what we call direct compensation property damage. So that would include not at fault cases where your damage is hit or your vehicle is hit. Or finally, applying the deductible across all claim types, including third-party damage. Typically, in these cases, it really depends what you prefer. Actuarially, the model is agnostic to the type of loss. And so when you're trying to optimize your insurance structure, it can very often make sense to apply the deductible across all claim types. But again, it depends on what pricing you're getting from the insurance market. If the difference between the current structure and the alternative structure two is not significant, and you're not getting meaningful premium credits to make that difference, it doesn't really make sense to take on that risk. Again, everything is a question of what am I actually getting for taking on that additional risk? So what we've provided here, and I'm not going to go too much into detail, but we provided essentially those numbers. So how much additional loss are you taking on if you do increase your deductible only for all peril claims? And how much are you taking on if you extend it to all claim types? How does that change from current state to a $50, $75, $100, or $250,000 option? We've also captured your worst case scenario in these tables. The important part for the group right now is just that once we get data back from the insurance market closer to renewal, we will benchmark these numbers against the numbers that we get from the insurance market. That's where you see that TBD over here. And we'll be using those numbers to counsel the city on, does it make sense to increase the deductible or not in this case?
Can I add a
The
point?
la-
Aye.
Can I add a point?
Yes, go ahead, Councillor Coonsey, please.
Just to back up a little bit, and you were talking about at fault and not at fault losses. In order for the other party, so our vehicle is involved in a collision and it's not our fault. The other person that did cause the accident, they actually have to have insurance in order for our insurance policy to not pay. If the other person that caused the accident isn't carrying insurance, then we're going to have to make a claim on our policy for our damages to our
Exactly.
vehicle.
Exactly.
Just-
It's a very important point, and it's something that's important to keep in mind. Very often, there's an idea of, well, that incident wasn't our fault. Why are we paying for it? But to your point, if someone isn't insured, there are also claim adjustment and just management costs that are incurred when the insurance company has to take the claim. So even if it's not the city's fault, sometimes cost can be incurred. We call those expenses in either case, even if there is no indemnity.
And the same can also work against people who are out there driving around. So if our vehicle is at fault and the other person is not insured, we don't have to pay for their vehicle. That's their problem. This policy would only pay for the damages to our vehicles.
Exactly.
Thank you.
The last point we want to make as well is, as part of the support that our practice offers the city, we had our fleet risk management expert also produce what's called a fleet risk analysis. So this process looks at generally how your risk management system or structures exist at the city with respect to your fleet, and provide not only a score of current maturity, which currently was considered moderate to good at a 7 out of 10, but as well provide some key insight into the components to improve and recommendations to do so. So not only have we looked at this from a pure actuarial lens, we also supported the city with a deeper dive into what could be done to improve the risk further. And so as you also invest into risk management for the city, it allows you to increase your deductible with more certainty that you're not going to get some of those catastrophic events that could happen. And the target maturity objective that was placed was at an 8 if all the recommendations are enacted over time. Obviously, those recommendations take time to put in place. They're not going to be put in within 6 months. But the idea is that maybe you take some of the premium savings that you're going to make by increasing your deductible, for example, and reinvest that into your fleet risk management, which creates a virtuous cycle of risk management improvement. And then the final point to talk about is, again, some of the ideas behind increasing your deductible. We don't look at this in a vacuum. The city has increases retention on general liability and on property. And so adding it on the auto profile, auto insurance will allow you to, number one, standardize your risk appetite. We're taking on a higher deductible across the board, maybe not $250K on auto from the first year, but something that could be considered. And then we're also diversifying our risk. So if I have a bad year on auto, some of the premium savings that I had on GL and property can subsidize that, and vice versa. It's very unlikely, typically, that you'd have a catastrophic incident that would impact multiple lines in this case. It can happen, but typically these are pretty independent lines of coverage. And so there's an advantage to increasing your deductible across the board, as the city has done in the past. That's it for our presentation. Are there any questions at this point or clarifications that people would like before we close off on this?
Anyone have a question? I have one. Where it says the overall, Quinte West achieved an overall score of 7, placing at the lower boundary of the formal optimum category. I'm wondering why it's at the lower boundary. And it also said there were 68 improvement recommendations. I'm just wondering how detailed are those and why we're at the lower category?
Sorry, so it's the lower category of that bound. So what we do is we break it down between lower performance to higher performance. So a 7 is a lower part of the bound of, I forget what the exact terminology is, but of that bound. So for example, I think it goes a 2 to a 4 is informal, a 4 to a 6 is semi-formal, for example. So it's just within that bound. It doesn't mean that a 7 out of 10 is low by any metric. It just means within that specific bound. And then from the recommendations, those are outlined in more detail in the report that was produced by our fleet management expert. But primarily, they're going to provide very specific examples of places to improve, benchmarked against the components found here. So for example, the incentive structure was given a 6.1 out of 10. There would be specific recommendations that would say, okay, how do we adjust our incentive structure to better mitigate our risk moving forward?
Thank you. Any other questions?
Yeah.
Councillor Quince?
You mentioned about the underwriters at the insurance companies slotting us into a bucket. But that's where you come in too, where you have information about our losses and our training program and our hiring processes. Because your underwriters are going to be looking at that information, like the CVOR, any classes of licensing that our drivers have, that sort of stuff. That's part of your communication to your underwriter, correct?
Exactly, yeah. So that would be part of the broking team's process. Obviously, we want to present the risk as accurately and as obviously positively as possible, especially in a case where here the risk profile is quite strong. It's more that when insurers are looking at pricing risk, they're not going to go into this level of detail. So they're not going to create an actuarial model to represent your specific risk profile and price it specifically. They're bucketing in, looking at your CVOR, looking at your loss history, looking at your high level exposure, and putting that information together. But ultimately, they're not trying to price your specific risk. They're pricing you according to your buckets. And so that kind of loses some of the specific advantages that you have when you invest into risk management that may not show up as cleanly in a CVOR, for example, or they may not take into account in the appropriate way because, again, they're using one methodology to price across the board for a specific line of insurance across your industry. They're not necessarily saying, well, Quinte West had this amount of investment here and this amount of investment there, and this is how that $1.8 million loss was actually a fortuitous loss. They don't go into that level of detail because they can't. They need to price across an entire portfolio. So there is obviously some specificity that's given, but up to a point. They don't go into the level of detail that we did here with the actuarial modeling.
How many auto insurance markets does your brokerage represent?
That would be a good question. So just for context, I'm not part of the broking team. We have a separate team that does the broking. We keep our expertise as well separated to a certain degree because, again, we're reviewing your pricing. So we want to make sure that we're giving a fair and honest answer. But that would be a good question. I would invite maybe afterwards to get in contact with the broking team on that piece.
And then does your brokerage have any recommendations for the upcoming policy changes that the provincial government is putting into place on July the 1st when it comes to accident benefits?
I'm
Is
I'm
that
sure the broking team. Yeah, so that's an interesting point. So just for context, from a modeling standpoint, then I can answer from a broking standpoint. From a modeling standpoint, accident benefits tends to be by far the lowest piece of risk. So even if we fully took it out or fully added it, it wouldn't really have any incidence on the final recommendations or structuring or anything like that. The actual expected loss is very low when it comes to accident benefits in these sorts of programs. But that is an important point. That change in legislation, I would again recommend reaching out to the broking team to provide more input on that, because it is something that's come up in a few cases, especially with respect to pricing, and it's something that we'll obviously take into account when looking at the premium credits, once we get that information closer to renewal.
And just the last question, when we were talking about deductibles, can we have two different deductibles, like one for heavier class vehicles and a smaller deductible for the private passenger type vehicles? Because we have one or two private passenger vehicles.
You absolutely can. That can be, it obviously depends on the insurer and the relationship and what's being asked, the level of specificity. But those sorts of adjustments can absolutely be made. The one caveat that we would say actuarially is that if you're looking at it from a transfer pricing perspective, so how much risk are we willing to take on versus what are we transferring to the insurance market, whether the $10,000 loss is 50% of a private passenger vehicle or 10% of a fire truck, ultimately it's a $10,000 loss. The insurance market is going to price you, if you transfer that to the insurance market, a certain amount of money, which is probably greater than whatever the claim would be just to pay it out of pocket, because it's a lower, more predictable amount of money, right? The best places for insurance are to cover those catastrophic worst case claims that could materially impact your balance sheet and your liquidity. So in those specific cases, from a broking perspective, those adjustments can be made. Actuarially, we look at it a little bit from a bird's eye view, and we say that typically, whether the $10,000 impacts a private passenger vehicle or not, the only two things that really matter is how does it impact our expected losses retained versus how much of a premium credit are we getting for taking on that exposure.
Got it. Thanks.
Thank you. Any other questions?
Perfect.
I don't see any other questions.
Perfect. Well, thanks so much, everybody, for your time. It's been great presenting to you all over the years. So yeah, thank you for everything, and thanks to Caleb, Mel, and Lisa for all the help and getting the information and helping us provide some context for the city throughout the project. Couldn't have done it without them. So thanks, everybody, and yeah.
Thank you. Have a good night.
Perfect. Take care. Bye.
Next on the agenda is public input. I don't see anyone here for public input. Next is correspondence. There's correspondence received later this afternoon. Would the Director of Finance like to comment on that? I know it was very late that you received it.
Yep, yeah, through the chair. So we did receive a correspondence through someone from Public, Robert Warham. Instead of maybe reading it out, I'll just kind of go to the questions that were there. I think, did everyone receive the public correspondence?
No. I didn't get
The email?
Yeah, it was sent by email.
That's
I
correct, yeah.
haven't checked my email since like this morning.
I've got a copy here. So, Mr. Warm mentions high experience of vehicle claims, and then kind of goes on to say that many municipalities are actively using Class 6 road classification. This specific designation is reserved for low-speed, low-volume roads and is utilized to reduce municipal costs related to maintenance and reduce municipal liability and exposure to property damage claims and other potential legal liabilities. I'll just kind of clarify that the city does use objective measures from the province under the Act on how to classify roads from 1 to 6. It indicates maybe that we don't use Class 6. We do have many Class 6 roads. It's based on traffic counts. So the city in just the last 12 months has updated our roads, so our roads are objectively measured. So we would not want to arbitrarily assign a Class 6 road to roads that are not Class 6 roads. And I would say that even further, even if we were able to, it would not be advisable to reduce our minimum maintenance standards on any Class 1 to 5 roads below what the province suggests. That would, in my mind, only increase potential issues. It may reduce liability on paper, but it wouldn't reduce the number of claims or issues that residents have. So I would say that, I'll just read the question, does the city currently have a formal policy regarding the reclassification of roads within the municipality? The policy isn't formal, but there is a policy to use the province's guideline, and we've done it in the last 12 months. The second question is the city utilizing the Class 6 road classification specifically for the purpose of reducing liability and damage claims? And the answer, like I said, we use Class 6 based on objective measures of road count and speed, and we do not use it for the purpose of reducing liability and damage claims, and I would highly advise against that. Yeah.
Thank you. Councillor Quinte.
Can you give an example of a Class 6 road?
Yes, so a Class 6 road would be a dead end, maybe in a rural area, where your speed, your average daily traffic is less than 50 cars per day.
Okay, thanks.
And there are also minimum maintenance standards. You can always go above to reduce your exposure, correct?
Exactly, yeah. If anything, I think this group and our reducing risk, we would want to look at overachieving on minimum maintenance standards, not underachieving on minimum maintenance. Those are the minimums.
Thank you.
Can we get a motion to receive it and file it, please?
Motion to receive and file it. Councillor Siddall, seconded by Councillor McHugh. All in favor? Thank you. Thank you for your explanation.
Thank you.
Next, items for committee's consideration. The first is staff report 26001 FIN by Melanie Monsieur. And the resolution is received the update on insurance actuarial analysis information. And the committee recommend that council authorize staff to negotiate the pricing and structure options for the city's auto liability coverage, the 2027 insurance renewal, and approve an increase of the deductible up to, it says at least 250,000. So would someone like to make a motion on Councillor McHugh?
I'll make that motion up to 250,000, yes.
Someone second that?
This is on the property insurance.
Auto.
CGO line deductible of 250,000 and a property liability line deductible of 250,000.
And
That's what it says in this report here. Talking about property liability line deductible of 250,000. Doesn't say anything about auto. Am I looking at the right
we're
one?
on A.
Say what?
Page
The report resolution.
8A.
eight.
And the staff report said gradually increase, not
Okay,
maximum
okay,
250.
whatever they feel, I guess, right?
Well, they're saying anywhere between 50 and 100,000. Councillor
On the
Siddall.
wrong page.
I would recommend with the auto liability and the information that was presented is that we not go to the 250, is that we wouldn't go over the 100,000. I think that that's more than adequate as a maximum, because the two incidents we've had in the last 15 years haven't been any more than $200,000. So I wouldn't see why we would do the deductible, otherwise we're self-insuring. So I would say up to a maximum of 100, and I realize this is part of the negotiations that'll go on when we start doing our tender, so that could change, but then I would imagine that it would come back to the committee and if there was other recommendations, but I'd say 100,000 would be maximum.
Would you be okay with
Yeah,
that?
the recommendation is up to, right?
I'm saying up to 100.
Up to, so
100.
100,000 is, everybody's comfortable, 100,000 is fine. Yeah.
Okay.
Are we allowed to ask questions then?
Absolutely. I need a seconder.
All second, or
Yeah.
who moved, I know we had a mover and a seconder already between the two,
At
so.
100.
Okay, yeah.
Well, except you changed it to 100,000.
No,
Yeah.
it says up to.
It does say up to.
I didn't say 250, it said up to.
But now we want a
Shelley,
Well,
specific
I want to change
amount.
to 100, okay, okay.
Yes.
Okay.
So I have questions for the staff. By increasing the city's liability coverage. This is confusing to me. The committee authorized staff to negotiate the pricing and structure options for the city auto liability coverage. So do we have a deductible when it comes to auto
It's
liability?
10,000 right now.
I'm not talking about physical damage, we're talking about the liability coverage on the auto policy. Do I understand that correctly? I'm just confused.
It's 10,000 on all perils only.
Go ahead, sorry.
Go
Sorry,
ahead.
through your chair. Currently, we have a $10,000 deductible on all perils only. So a nil deductible on other
Correct. Coverages.
coverages. So,
But the auto policy has many sections to it.
and the recommendation staff is putting forward is that we be able to ask for we can ask for all of the price points and potentially structure options for the deductible to be applied in various ways.
Which is why
And
you
to
wanted
potentially
it,
raise the deductible.
which is why you wanted it up to 250,000, so you could have a higher deductible for liability claims, zero deductible for accident benefit claims, and whatever for actual physical damage claims to the actual vehicles. Is that what you're trying to do?
Through Chair, we're trying to see a multiple combination that our insurer can provide to consider pricing points for the various structure options beyond what we currently carry.
And currently, we still just have you and Lisa are handling the insurance claims.
And we have one other staff member who assists as well. So
As well.
part of the consideration will be price point balanced with the reality of what the workload may be.
That's
So
what
part
I'm
of the-
worried about.
Part of the discussion is potential workload.
And then we still have our adjusting firm that we can reach out to for help as well. And how often do we talk to them? Every day?
Every day.
Which is why you wanted the 250,000 limit. And then you would negotiate and come back to us as to what the deductibles are going to be.
Correct.
So I think with the amount of income the city has and the number, like how many vehicles do we have?
132, I think.
How many?
Like, so I saw it's only 232 vehicles somewhere, on the report that was said.
Yeah, 232 vehicles,
232.
$10 million valuation.
And how many of those are the lighter class vehicles, like under 3,500 kilograms, or do we know?
Through Chair, I don't think we had that breakdown in the list. We can get that information.
Approximately 60, 70 of the snowplow trucks with the tandems and triaxles.
Yeah, correct, I don't think more than that.
Yeah.
So a lot of them.
But did you not also say the city should gradually increase its auto deductibles toward the 50 to 100K range and not at 250?
Through Chair, yeah, yes, the actuarial analysis report does recommend a gradual increase, and we're not necessarily saying we want to go right to 250. And we would like to see the point options also to inform us for future years to come, to give us an idea of what we may be facing, or
Yeah,
for positive or negative.
okay. I'll go with the 100,000 then.
All those in favor? Pass, thank you. Staff report 26002 FIN by Melanie Monsieur, Manager Purchasing and Risk. That the committee receives the update on insurance and risk management activities and the 2026 insurance risk plan as information.
I'll move it.
Moved by Councillor Coombs, seconded by Mr. Sanford. All those in favor? Passed, thank you. Staff report 26003 FIN by Matt Hodge, Manager of Finance. Quite a few resolutions. The first, the Quinte West draft consolidated financial statements as presented, approved. The second, council approved the 2025 City of Quinte West draft trust financial statements. Further, council approved the 2025 Quinte West water and wastewater draft financial statements. Further, council receives the 2025 Quinte West Public Library draft financial statements. And further, the committee receives the 2025 Downtown Business Improvement Association draft financial statements. Who'd like to make that motion? Councilor Quincy, seconded by Ms. Whitten. Are there any questions or discussion anyone would like to have on these? Councilor McHugh?
I'd just like to point out, I think it's good news here that the budget reserve transfers are more than the value of the appreciation of the city's assets. It says this is an important milestone. It's also important that the note there's still room to improve, so it's good news.
Wait till next December
Well-
31st.
Thank you. Yes, Councilor Siddell.
Just a couple questions. So just going through these reports, can you remind me again why our water and wastewater is a separate entity report? Is that to do with when we originally took over the utilities back in whatever it was, like 2001? Is that why it became a separate entity?
Through your chair, yes, and you have to report to it's the Water Commission. We do have to submit separate financial statements. They're not separately audited financial statements. Like the audit is strictly on the consolidated, but we do have to produce separate financial statements for water wastewater so that we can report that the water wastewater enterprise can operate on its own and can stand on its own without tax revenue supporting it.
Okay. So, Chair, my second question has to do with the library. They have looks like, from what is a cash surplus, and they've got a growing reserve. It looks like a cash reserve. If I'm getting the numbers correctly, they're up to 436,000 K that's in their reserve. Is that correct? And you can come back to me with this, but the reason I asked that question is that number is growing substantially, and the city is also contributing to the library, like we fund their operations of 1.8 million, so is there any reason that they've got that reserve growing? Is it there?
Through your chair, the last time they used it was when they did the renovation, like the maker space and the renovations to their area. So they do build up the reserves to be able to take care of those type of things, and if they have any operating deficits throughout the year, then they can use their reserves as well.
Okay, it's getting to be a little bit high, but
Through your chair, it's a draft loss on the accrued basis, it's a loss of 77,000.
Right.
Their net asset position would have decreased in the year. And then I see you're looking at page 6, then that change in net financial assets.
I guess, like, it seems like they have a surplus. Has their board reviewed their statements? The library, I'm not familiar
They're
with
going
them.
to the board tomorrow.
Okay.
So this committee is to receive these last two, the library and DBA. Those boards will receive these statements and approve them at the board level.
Okay. Yeah, 'cause that would be my question to them, is
Good.
what's the plan? I mean, the same thing with DBA, and I know I'm sitting on that board. We have $130,000 surplus, is that, I know they haven't got any specific plans, but that should be asked, I believe, back when, the DBA is different. The DBA taxes are being levied from property owners, like, from just in that particular area, but the library is across the city, like complete general taxes. That's all.
Reserves for the library,
It's a lot of work.
The, sorry, through you, Chair, the reserve, library reserve is split up into two, so the building is 350,000. Right now is their balance in the building reserve, and then they have ones that they've set aside from prior years that they just named it upgrades for 50,000 to make up the 400,000 reserve balance, total reserve balance.
Anyone else have any
And-
questions?
Sorry, and they do have a refund and special purpose for 63,000.
Right, I had a couple questions that I sent to the treasurer earlier. For the consolidated statement of operations, the actual surplus was $14 million lower than budgeted. And the provincial grants were almost $9 million lower than expected. And if you could just explain why that was the case.
Yeah, through Chair, I can explain simply from the cash basis to accrual basis. So the cash basis, council approves an operating and a capital budget. The operating budget, all the revenues and expenses, they match what you'll see here on the financial statements. But when it comes to capital, if only half of the capital is spent, so let's say we approved a 30 million capital budget, but only 15 is spent, and those capital projects will carry forward into the next year. The revenues used for those capital expenses, they won't be recognized until the year the capital is spent. So even with the provincial grant money, we cannot receive it from the province or federal government until we spend it on the project. So we may have budgeted to bring that money from the province and feds in 2025 and spend that money on capital. Because we didn't spend that capital, we don't have the revenue to recognize. The same would apply to development charges. Even though we collect development charges, it's sitting in deferred revenue and it's not recognized until we spend the capital money. So it's simply deferred capital projects that are pushing that revenue into later years.
Thank you. And then with the wastewater statements, the surplus was $2.5 million lower than the budgeted amount. And I noticed the amortization was $1.3 million higher than the budgeted amount. If you could just explain that for everyone too, please.
Yeah, through Chair. So that's more of an oversight, I think, on our side. When we do a cash budget, we don't show depreciation, or we do, but it backs out. So council doesn't actually budget for depreciation because they budget for capital. So when it comes to the accrued financial statements, and it has to have a line for depreciation, budgeted depreciation, that figure has not been updated by our team. So it's mostly irrelevant. It's not used during budget, and it doesn't actually affect the actuals. But our team is going to go back and kind of refine that budgeted amortization so that it doesn't show such a variance. So I appreciate you bringing that up, and we're going to refine those budgeted amortization figures so the variance doesn't show.
Great, thank you. Any other questions?
Just one,
Two, it looks like.
two. I always love depreciation. Like, we just make it up. So, like, for an example, on our buildings, what's our depreciation we do on our buildings? What's our depreciation on, like, our desks and chairs and computers? Like, what do you get, like 50% on computers? And on our automobiles, like, everything is different. And that's how you do it? Or not
The
necessarily
accountants love
you?
these questions. We don't get these questions on a daily basis. I'll let my colleagues answer the
Sure.
metrics we use on our
Yeah, that's what we're
organization
paying them for.
Yeah.
Through you, Chair. Yeah, it's mostly based on the useful life. So the building, we even break it into components. So like the structure of the building, the roof, the internal components, they all get depreciated over a different time period. Same as roads, there's the base, there's the surface, there's the curbs, there's sidewalks. So yeah, it's all went through and trying to figure out what the average useful life is, and then when we capitalize the asset, we depreciate it over that time period. It's based on historical costs, so that's that comment in the financial statement report is that should be our bare minimum, because those costs that we're bringing in every year over the 100-year lifespan for the base of a road, that's really the bare minimum, since that cost that we're depreciating is 100, could be 100 years old that we're bringing in. So being able to capitalize and have a reserve transfer that at least matches depreciation should be our minimum, just because it's based on historical value. So that's our goal, is to keep updating that capital transfer to match the asset management program, which is
Another
more
fun
tied
topic.
more tied to actual costs to replace assets.
And then we fill the cracks on the road, or we put a new roof on a building, and it changes everything.
Correct. Yeah, there's disposals and
See?
additions per
You just make it up.
category.
Well, I'm pretty sure the manager of finance didn't make the numbers up. He has rules on the different assets that he's allowed to depreciate and the time over it.
Sure.
Thank you for
The
your
auditors check it
explanation.
out. Yeah, it's fully verified.
Councillor Siddell?
Yeah, I just wanted to thank staff. On page 44 is the summary of each of the different surpluses and deficits and within each of the different departments, and that really resonates with me when we come back to budget, and I really hope that we can somehow get that, capture that, and bring it to the rest of council, because I think that they need to understand where, you know, the surpluses and deficits happen, especially when you take a look at, you know, doctor recruitment was over budget, and then we're finished with that reserve. You know, fire was under budget, public works was under budget. What was, you know, like those types of details I think matter, and to get close to $274,000 at the end, even though it was a deficit, I think that is a good news story, because this is like multi-millions of dollars. But I will ask this question, I think I asked it last year. The building department, the lower revenue than budget, it's coming out of the tax rate stabilization. Like usually the building department should fund itself if the fees are high enough, and it still doesn't. It still is it a deficit because our fees are not high enough? Is that, I don't.
Through your chair, yes, we did do the building rate study and analysis last year, and did increase the rates, but the volume hasn't caught up as well. There was a portion of the building rate study was to be picked up by the tax base, so it's not going to be full break even. There's a portion of their costs that will be picked up by the tax base, but in the past couple of years there hasn't been enough volume to substantiate profit for them.
And the only reason I bring it up is because I've seen in other municipalities where there's a big surplus. I know there's a municipality just north of us here, it has like, you know, 2.1 million sitting in surplus, but it's because of the fees were high enough over the years, and that's what happened. But anyway, that's great that we're working on trying to get that one so it won't affect our taxes. But thank you for the explanation.
Any other questions? All those in favor? Passed, thank you. Staff report 26004 FIN by Matt Hodge, Minister of Finance, and that the committee receives the year-end debt balances as attached. Moved by Councillor McHugh, seconded by
Quinte.
Councillor Coetzee. All those in favor? Passed, thank you. Staff report 26005 FIN by Matt Hodge, Minister of Finance, that the committee receives the 2025 year-end development charges, treasurer's statement with reserve funds. Someone like to make that motion? By Councillor Siddell, seconded by Ms. Whitten. Any questions?
Go development charges. Woohoo!
All those in favor? Thank you, passed. Staff report 26006 FIM by Matt Hodge. Committee receives the 2025 year-end consolidated reserve and reserve fund report. Someone like to make that motion?
Oh, got a hand up on the screen.
Oh, okay, sorry.
Mr. Brawley?
Mr. Bradley,
Yes,
would you like to make that motion?
sure. And I'd like to
Okay.
take my hand down too.
Okay. Okay, seconded by Councillor McHugh. All those in favor? Pass, thank you. Staff report 26007 by Matt Hodge. That committee receives the 2020, the 2000, regarding the 2025 investment results. Someone like to make that motion?
Sure.
Moved by Councillor Quinte, seconded by Mr. Sanford. Any questions or comments?
Yes.
Councillor Quinte?
How much fun is it in the investment market these days, I tell you? So as I understand, we have not made a contribution to the JIB 1 fund for quite some time, correct?
Your Chair, correct. We've only withdrawn since 2022, 5 million, but otherwise we've not contributed any more since 2022.
And do we have any plans to make a contribution in 2026?
Through the Chair, no, in our long-term plan that we submitted, investment policy, we submitted to the one JIB. We do not have any contributions towards them. We lay out over the next 10 to 20 years what we think we will either contribute or withdraw. We do not plan to contribute anymore.
In 2026 or 2027
In
or
the
any
full
time
plan,
soon?
we didn't have any plans to contribute more.
Okay, good.
Any other comments?
Thanks.
Councillor Seville?
Just a comment is that, I mean, that's a good thing, because we're actually funding our debt internally, right? And so we're saving the money off that. So even though we're not making more money off investments, we're saving the money off the debt side that we would be paying if we were borrowing from outside.
Yeah, through Chair, there's a couple of components. One is just we're always have a cash balance, so instead of that sitting in low interest bank account, we know we've always got a balance. Some of it we're spending, for example, OSIP and gas tax, so CCPF, we spend in the following year, so we know we always have balance there. So some of that we just put in long term, so we receive a better rate of return over the long term. And then we also have some geared to debts that we haven't taken on yet. For example, the Wooler Road Bridge, some of that was earmarked several years ago, so that's earning investment revenue. And the gains on this investment should hopefully be able to pay down some of these debentures. And I'm pleased to say, 4 years in, we're average returning of 7%, and our debentures are on average less than 5%. So it's a good thing for the city to have some cash investments. And even for our asset liability ratio, it is a good thing to have some long-term investments on our balance sheet as well.
Councillor Quinte?
I want to agree with Director Denowden that it's good what we're doing. We've got a little bit of risk and we have some with no risk, and we're using our money for good things. And we are earning interest or revenue from the investment fund. It is doing a little bit better than the interest rate, but I'm comfortable with how we are doing things.
Thank you.
And I'm comfortable that we are not investing any more in the JIB 1 fund. Thanks.
Any other? I did have some comments that I talked to the Director of Finance about. What I felt, the report included extensive commentary and outlook, but dedicated only one page to actual results. I believe the focus on this report should shift towards actual performance compared to benchmarks, specifically detailing the reasons why relative performance was lower. And I'd like to take a look at some other reports and changes and believe they were making, oh, sorry, that's your response. But basically, they only gave one page for results, and the rest really wasn't relevant to me. They need to tell us what they've done, how it's happened, and how it relates to the benchmark.
Yeah, through the Chair, I'll relay this information. I think this was the year-end report. Our quarterly reports, I think, have been updated a little bit, but I'll continue to work with them. They're constantly learning. There's actually good news of several other municipalities that are joining this fund. So as they get bigger too, they're getting more a little bit better at their reporting, and they're improving every year, so I'll pass on the.
And I agree, the reports have got better, but we have, I feel, pushed them to make them better. Thank you. All those in favor? Thank you. Staff report 26009 by Matt Hodge, that the committee received the 2026 audit plan and engagement letter as information. Who would like to move that resolution? Councillor McHugh,
I'll second it.
seconded by Councillor Kunci.
Just ask a question.
Absolutely. Any comments or questions?
Just a question about, so this is to re-engage same auditors. When did we go back out, when did we go to tender?
Market.
Wasn't it last year?
This was, through your chair, this was our first audit year, this current year.
It's for 5 years, right?
Is it 3 or 5? It's 5? 5 years, okay. Thank you.
And our bill was for this year
Oh, it's in there.
$52,000.
I think that's each year for 5 years, is it not? We not have a contract, sorry, through you, Chair, do we not have a contract for 50-some thousand a year for Wilson to do all our work?
That's correct.
Yeah, right.
Thank you. All those in favor? Passed. Oh,
Number H, or letter H.
Yeah, number 8, I thought.
oh,
Where you get home.
Sorry.
sorry.
Good thing you're here paying attention.
Staff report 26008 FIN by Matt Hodge, Manager of Finance, regarding the 2025 financial information return. And that the committee received the financial information return. Moved by Councillor McHugh, seconded by Councillor Siddell. Could you explain what the FIR is to members of the public?
Through your chair, yes.
And
It's-
us.
It pretty much takes our financial statements and then gives more detail that we have to submit to the province. So it's a structured spreadsheet that all municipalities, all 440 of us have to submit that is exactly the same. So it breaks our financial statements down a little bit more, and then there's some more detailed information, like statistical information that is also required to be submitted, and in the end, it gives us our debt limit that we get from the province. So the debt limit that we've received from this submission of FIR, it spits out the how much total payments we can make per year. If we flip those payments into a 5% 25-year debentures, that gives us roughly $268 million worth of total debt that we can take on as our limit. Currently we have $100 million. We've committed to another $50 million through budget process and committed capital projects, so we're at like $160 million out of the 260 current debt limit.
And it also tries to make the statements from the different municipalities more comparative.
Correct.
And with the annual debt repayment requirement, Director of Finance, could you comment on how close we are to the limit and what happens if we exceed the limit or are close to exceeding the limit?
Yeah, so through chairs, as Manager Hodge mentioned, we're about 2/5 or 40% up to the limit with what we have committed. The province and Infrastructure Ontario are aligned in that. I think Infrastructure Ontario would deny us any debentures that would exceed our limit. And if we get close, I'm sure we would receive a call. So as a treasurer, I would not present a case where we approve capital projects and we're in a position where we exceed the limit. I would not recommend council approve projects to that degree. And if we were in that position, I know of one of the municipalities who did have to approach the province because they knew they would exceed to get some of their capital projects done. And I think they received temporary approval to go over that limit, but we are not there.
Are we projected to get there anytime soon?
No, in our long-term capital plan, we are not projected to exceed our debt limit.
But the higher debt we have, the less we can do for capital projects because our repayments are on the debt are higher.
Mostly, most of our new debt is coming on related to development charges and growth. And so there is some constraints there in terms of cash flow for the development charges, but the impact of additional debt that we've got planned in our capital plan on the taxpayer or the water wastewater ratepayer is limited. It's getting more limited every year because we're getting to a more sustainable position with reserves paying for the capital projects. So we're actually getting into a better position than we were historically with the less use of debt for those areas, but we are using more debt for growth.
Great, thank you.
I want to make a comment. I think debt is a good thing, because we are getting things done, and building and improving. And this debt is helping us to make our city better. So I see it as a good thing.
Some debt's good, some debt's bad, as far as I'm concerned. And it all depends what you spend it on. If it's for capital improvements to increase our capacity, I agree with you. If it's for other things that don't improve the city, I don't agree.
I don't know of too many projects where we are not improving the city.
I'm not gonna get into that right now. Thank you. Councillor Saville.
Just to comment on the FIR, kudos to staff for filling it out and completing it. It is, I would recommend everybody around the table try one of those because they are a challenge. And it's the provincial report card for more than just debt. There's lots of other things. It gives us some comparables, and if anyone is interested that, might be thinking about running for the next term of council, they might want to go on there and do some comparables to some other municipalities. Like it's got the provincial website has got, you can pick any municipality and pick anything on the FIR and do some comparisons for it. It's really good information. It's available. Nobody does that.
Thank you. All those in favor? Pass. Thank you. On to new other business. Any new other business? Don't see anything. Adjournment?
Chair, so I see Mr. Warren's here. I don't know if we want to suspend the rules in that public, no.
Sure. Mr. Warren, we did discuss your,
I'm satisfied to receive an update from anybody afterwards.
okay, perfect.
I don't need to make you do it again.
Okay, I just wanted to make sure.
I appreciate that.
Thank you. Would someone like to move for adjournment?
Steve Crawley.
His hands down.
No, he did put it out.
Okay. Seconded by Mr. Sanford. All those in favor? Passed. Thank you.